Good morning and welcome to the Killik and Co market update. It's been another very difficult week for markets. A couple of weeks ago we talked about the S&P 500 index briefly dropping into bear market territory during a trading session, but this week on Monday the index closed in bear market territory, and that means it's down by over 20% since its high of January this year. On this chart here you can see there has been quite a sharp decline in the index over the course of the last week. We've also seen quite a rise in volatility. Here's the VIX index, which shows expected levels of future volatility, and you can see it has gone up quite a lot over the course of the last week. We're now back to where we were in February when Russia first invaded Ukraine. So what's causing all this concern? Well, markets are still worried about inflation and interest rates. Although sales for companies are still holding up quite well, we're now starting to see that inflation is feeding into costs, and that's starting to bring down profit margins for companies. When investors are deciding whether or not to buy a particular share, they often look at PE, or price to earnings ratios. The lower the price to earnings ratio, the more attractive a share is considered to be. However, if earnings or profits start to fall, that will mean that price to earnings ratios will rise. In terms of interest rates, it's long been expected that interest rates around the world will start to rise. However, this week the scale of expected rises has really increased. This week, the US Federal Reserve raised rates by 0.75%, which is the biggest single increase they've implemented since 1994. The Bank of England has also implemented 5 consecutive monthly interest rate rises. Here's the latest dot plot for the Federal Reserve, and this shows where the members of the rate setting committee expect US rates to be in the future. So you can see that they now expect interest rates in the US to be between 3 and 4% by the end of this year, going higher next year before falling a bit in the future. When interest rates rise, bond prices tend to fall. Many investors hold bonds in a portfolio as a safety net, but over the last few months, we've experienced declines in the prices of both equities and bonds, and that's caused concern for many investors. Here's a chart showing the 10-year performance of an ETF that focuses on UK corporate bonds maturing within a 5-year period, and you can see there's been quite a sharp sell-off over the course of 2022. Buying bonds over the last few years has actually been quite difficult because the prices have been so high that the potential returns have been incredibly low. So the good news at the moment is that following the sell-off, there are now some fairly short-dated bonds available at much more reasonable prices. So please do give us a call if you'd like to talk about the bond market in a bit more detail. And finally, fast fashion appears to have fallen out of favour. Here we've got the share price charts for ASOS and Boohoo over the last 5 years. And you can see they've both fallen heavily recently, and over the last 5 years they're both down by over 75%. The latest series of Love Island has just started, and historically this show has focused very heavily on fast fashion, but this year eBay is one of the main sponsors, and the contestants are being encouraged to wear pre-owned clothing, so perhaps this is an indicator that fast fashion has fallen out of favour. Moving on to have a look at next week, it's fairly quiet on the calendar, but we are expecting results out from Accenture. That's it from us. Enjoy the weekend, and we'll see you next Friday.